Good morning, dear learners. I am Dr. Abhijit Vishwas, Assistant Professor at the Institute of Management Studies, Banaras University. Welcome back to the course on Essentials of Financial Management. This is week 2, lecture number 6. In week 1, we discussed about the concept of finance, where we learned about the traditional view, modern view, what is financial management, objectives of financial management, that is profit maximization, wealth maximization, and different forms of business organizations. In lecture number 6, that is on over-capitalization, we are going to discuss about what is capital and capitalization, fair capitalization, over-capitalization, what are the causes and effects of over-capitalization, and finally what are the remedies for the problem of over-capitalization. So, let us start this lecture. So, what is capital? So, financial resources a company uses to fund its operations and growth. So, capital are the financial resources that any company requires to fund its operations. It is the lifeblood of any business. Like circulation of blood is essential for the survival of human beings. No human being can survive without the proper circulation of blood. Similarly, capital has been considered as the lifeblood of any organization because capital is required for everything, right from inception of a business to managing its day-to-day activities. Everything, capital is essential. It facilitates the production of goods, payment of employees, invest in new equipments and expansion into the new markets. As already discussed, capital is required for everything, whether it is you are purchasing goods or raw materials, whether you want to pay wages workers, whether you want to purchase a new equipment so that you can increase your productivity, or you want to expand into new markets, you want to make some surveys, understand the requirements of the market. All these activities require some amount of capital. Now, what are the different types of capital? The first one is equity capital. A company can issue equity shares or sell ownership in the company and raise equity capital. Next is debt capital. The company can issue bonds or debentures and can raise debt capital. It is similar to a loan. Working capital. Working capital is required for managing day-to-day management of a business, like you want to pay wages, you want to purchase raw materials. What is the importance of capital? First one is to help the business start and grow. So, right from the inception, capital is required. If you want to start a business, you need capital. You want to expand the operations, expand the or increase the scale of the business, you need capital. Fund operations. So, managing your business requires capital. If there is no capital, you cannot manage your business in a smooth manner. Making investment in the future. So, let us say a company wants to expand, it wants to do some R&D related activities, it wants to make an investment. So, all these activities will require a certain amount of capital. Now, why managing capital is important? Forecasting cash flows. A company should be able to forecast the cash coming into the business and cash going out of the business. It is like synchronizing both these things. It is about to successfully synchronize these things and then it will have a surplus capital with itself. Budgeting. A company should have an idea about the expenses it is making. The expenses should not exceed the revenues, otherwise it will be having a hard time managing the capital. Now, the next topic is capitalization. So, let us understand the concept of capitalization. What is capitalization? Most important constituent of a financial plan. Whenever a company makes a financial plan, estimates the requirements, capitalization is one of the most important parts of that. Used in quantitative sense, that is the process of determining the quantum of funds that a firm needs to run its business. So, firm needs to estimate what is the total funding required. So, it is a process of determining the quantum of fund. Let us say there is any project for which a business requires rupees 100 lakhs, right. It can have different sources where it can raise rupees 100 lakhs, but this 100 lakhs will be considered as the capitalization of the company. Composition of capital is called the capital structure. So, the segregation or the proportion of various securities in the capitalization of a company is considered as the capital structure. Now, going back to the previous example, let us say a company requires 100 lakhs, it can raise 40 lakhs by issuing equity shares, 40 lakhs by issuing debentures and the remaining 20 lakhs through, let us say, preference shares. So, this segregation of 40%, 40%, 20% is the capital structure, whereas this 100 lakhs is the capitalization of the organization. Capitalization is the sum of the face value of stocks and bonds outstanding. So, this definition was given by Guthman and Daugel. He says that it is the sum of face value of stocks and the bonds outstanding. So, whatever the equity shares a company has issued and the debentures or the bonds that the company has issued, the face value of that is the capitalization of the company. Similarly, Bonville and Dewey say that the balance sheet values of stocks and bonds outstanding is the capitalization. Similar? Okay. Now, long term financial resources available to a company are equity. We have already discussed this. A company can raise funds by issuing equity shares. They provide ownership rights to the equity shareholders. Similarly, the other long term sources include the debt. The company can issue bonds and debentures, and the owners of this are considered as the bond holders or debenture holders. And retained earnings, if a company retain a part of the profits that it is making and distributing a part of the profits with the shareholders, the retention of profits year after year can be considered as retained earnings. Now, whatever we have discussed till now is the traditional concept of capitalization, and it is a narrower concept or a more popular concept. But according to the modern concept of capitalization, we should also include two things apart from the share capital, long term debt, reserves and surplus. We should also include short term debt as well as short term creditors. Right. Now, let us come to the cost theory of capitalization. There are two theories of capitalization. One is the cost theory and other is the earnings theory. So, let us first discuss what is cost theory of capitalization. So, it is a fundamental approach to determine the total amount of capital a company needs to raise. So, it is a very basic approach of understanding, estimating the total amount of capital a company requires for managing its business. It focuses on the cost of acquiring assets necessary for the businesses to operate. This entirely focuses on the cost of assets. So, let us say a company requires 30 lakhs of assets to start a business. So, from this point of view, the capitalization for the company would be 30 lakhs. So, it is the cost of acquiring assets necessary to operate a business. Now, company's total capitalization should be equal to the sum of the cost incurred in acquiring both fixed assets and current assets. So, when you are talking about cost of assets, it includes fixed assets as well as current assets. So, what are fixed assets? Fixed assets are used by the company to make profits. They are not meant for resale purpose and they are used for a longer period of time. For example, let us say land, building, vehicles, these all are the fixed assets for a company, right. What are current assets? Current assets are converted into cash in a reasonable shorter period of time. Let us say we have cash, inventory, these are the current assets. So, total cost which is incurred by the company in order to acquire the assets as well as the current assets is considered as the proper capitalization of company as per the cost theory of capitalization. So, now let us understand this with few examples. So, total capitalization of a company according to this would be the cost of land and building, which is a fixed asset, the cost of plant and machinery, which is again a fixed asset, the value of raw materials inventory, that is a current asset, value of work in progress inventory, this is again a current asset, value of finished goods inventory, this is again a current asset, amount of account receivable, which is again a current asset, and finally the cash in hand which a company has, these all current assets. So, with examples we are very clear what are current assets and what are fixed assets for a company, and together they constitute the capitalization for a company. Right. Now, what are the advantages of cost theory? Now, the first and the basic advantage is it is very simple to understand. You can easily calculate the requirement of assets that you need to acquire, and on the basis of that you can get the capitalization of the company. Useful for new businesses, a new firm can get an idea what are the current assets or what are the fixed assets that they require. On the basis of that they can decide the amount of capitalization. Right. But there are certain limitations of this theory also. So, let us delve into that. The first one is ignores earning capacity. So, this theory does not focus on the earning potential, the probability of returns that an asset can actually give to the company, make for the company. So, it is not focusing on earnings of the company, does not account for obsolescence. It does not take into the fact that the assets might get depreciated, they needs to be replaced after a year. That is again this thing is missing, not suitable for all businesses. Now, let us come to the next theory, that is the earnings theory of capitalization. So, what is earnings theory? Capitalization of earnings method. So, again it is also known as the capitalization of earnings, because we try to determine the capitalization of a company on the basis of the earnings of the company, on the basis of the future potential. Determines a company's total capitalization based on the earning capacity that we have discussed. Unlike the cost theory where we emphasize on the cost of assets, here we are emphasizing on the earning capacity or the earning potential of a company. Emphasizes the company's ability to generate profits as the key determinant of its value, consequently capitalization. So, this focuses on the ability of a company to generate returns, generate profits, and on the basis of that we determine the value of the company and consequently the capitalization of the company. Now, there are two things which are essential as far as the earnings theory of capitalization concerned. The first one is estimation of the future earnings. So, that is the first thing. You should be able to project what would be the future earnings for the company. And once you have estimated that, the second thing is to determine the capitalization rate. So, what is capitalization rate? Capitalization is the normal rate of return or which the investors expect to get. So, that is the capitalization rate. So, we can calculate the capitalization using the earnings theory on the basis of this formula. What it is? Estimated future earnings, and if you divide this by the capitalization rate or the normal rate of return or the rate of return which is being enjoyed by the similar kind of companies in the same industry who are taking a similar kind of risk, that is what the capitalization rate is. So, if you see, if we increase this capitalization rate, let us say, what will happen? This capitalization will go down because it is in the denominator. If we reduce this capitalization rate, this capitalization will increase because it is in denominator. So, controlling or using a different kind of capitalization rate, you can actually increase or decrease the amount of capitalization. That is why getting or calculating this capitalization rate is very, very important. We try to estimate this capitalization rate and it is very important. Now, let us understand this with an example. Valuing a mature company. So, let us say there is a mature company which is having a regular earnings, and let us say it has projected a earnings of rupees, let us say 10 lakhs in the next year, and we have taken a capitalization rate of let us say 10%. So, we will divide this 10 lakhs by 10%. So, the capitalization on the basis of this would be rupees 1 crore, right. Determining the selling price of a business. Now, in event of liquidation or winding of a company, the company can project the future earnings of a company. On the basis of that, the selling price of a business can be calculated. The company can project the earnings and as well as it can decide a proper capitalization rate and can find the suitable value of a business. Now, what are the advantages of earnings theory? There are a few advantages. Focus on earnings power. Unlike the cost theory, this theory focuses on the future potential or the earning capacity of a business to determine its value and capitalization. Considers future potential. So, there are some limitations also. Difficult in estimating future earnings. Although we say we need to estimate future earnings, it is very difficult to estimate something which is upcoming in the future because an element of uncertainty is there in the future. We cannot predict what will happen tomorrow, day after tomorrow. Estimating something 1 year down the line, 2 years down the line, 5 years down the line becomes relatively much difficult, and it is very difficult to estimate it with that precision and accuracy. Subjectivity in determining the capitalization rate. We say we will take the normal rate of return or which is being enjoyed by the similar kind of companies, but estimating or determining this capitalization rate with accuracy is again is a subjective matter. Ignores asset value. We have seen that this theory entirely focuses on the earnings, and in some cases the asset value should also be taken into consideration, where in event of liquidation we need fixed assets to calculate the value of an organization. Now, let us talk about the next concept, that is fair capitalization. So, what is fair capitalization? Fair capitalization tries to strike a balance. Balance between what? It tries to find a sweet spot where a company has enough capital to fund its operations and growth, but not so much that it burdens the company with excessive debt or dilutes the shareholders' value unnecessarily. So fair capitalization is all about having an adequate capital, neither too much of capital, neither lesser of capital. So it tries to make sure that it is having sufficient amount of capital to fund the operations, but it does not have that much of capital which unnecessarily puts burden on the company. If company has more capital, that means it needs to pay more interest, it needs to pay dividend to the shareholders, that will again create a problem. If company has lesser capital, then it will not be able to manage its day-to-day business in an effective manner. So it tries to strike a balance. There should be a justification for having an appropriate or fair amount of capitalization. It should be supported by sound financial analysis. It should be aligned with the company's long-term strategic goals. And what are the considerations for this? Various factors which include company's assets. We have seen, we take into consideration the assets in the theory, in one of the theories. Then earnings, we take this into the earnings theory, cash flow, industry trends, economic conditions. So these all factors are taken into consideration to determine the fair amount of capitalization for a company, right? We take into consideration the assets and liabilities when we are talking about the cost theory. We take into consideration the earnings when we are talking about the earnings theory. The economic conditions are also very important. What is the importance of fair capitalization? First one is investor confidence. If a company is fairly capitalized, it sends a message that the company is wisely using its capital and the risk in the company is also not that high. So in that case, the investors feel confident to make investment in that company. Financial stability. If the company is not using a very high amount of capital, that means the financial risk to the company is also less. So it provides a financial stability to the company. Cost of capital. Every company would like to minimize the cost of capital, and right proportion of debt and equity would help a company to minimize the cost of capital. Now let us talk about the next concept, that is over-capitalization. So what is over-capitalization? As stated by Gerensberg, a company is over-capitalized when its earnings are not large enough to yield a fair rate of return on the amount of stocks and bonds that have been issued, or when the amount of long-term securities outstanding exceeds the current value of fixed assets. So there are two things which we are discussing in this. First of all, we are saying that it is considered as an over-capitalization state when the earnings are not large enough to yield a fair rate of return. That means whatever the fair of return is, let us say the fair rate of return enjoyed by the similar company is in 10% and the company is only generating 8%. So that means it is not generating a fair rate of return on the amount of stocks and bonds it has issued. So in that case, we will consider that the firm is over-capitalized. The second thing in this definition is when the amount of long-term securities. What are long-term securities? When we are talking long-term securities, we are talking about the equity shares, preference shares, bonds, debentures. These are long-term securities. They exceed the current value of fixed assets. So we know in balance sheet we have liabilities on one side, assets on one side. When these long-term securities exceed the quantity of fixed assets, that is again a case of over-capitalized. Now according to Harold Gilbert, when a company is unable to consistently earn the prevailing rate of return, prevailing rate of return is the normal rate of return being enjoyed by the similar kind of companies in the same industry having similar kind of risk characteristics. On its outstanding securities, considering the earnings of, we have already discussed this, it is said to be over-capitalized, the same thing that we have discussed just now. Now over-capitalization is when a company has raised more capital than it can effectively use to generate profits. Whatever your requirement is, let us say your requirement is of 10 lakhs which you can profitably use in certain investments, make certain investments of that to generate returns. But you have raised 20 lakhs, you have raised 30 lakhs, you do not have profitable avenues to invest that money. So that is a case of over-capitalization. What it reflects? It reflects excess capital, we have already discussed, inefficient use. When you have more capital than required, obviously you will not be able to use it in an efficient manner. You will try to park it or invest it in some low return avenues from where you will not be able to generate decent return. Financial burden. Obviously, if you have raised more either through equity shares or through debentures, you need to pay dividends, you need to pay interest regularly. That is again a burden for the company. Now, we should understand that there are two terms, one is over-capitalization and one is excess of capital. These two are not similar terms, although they are close, but there is some difference between these two. So, we should understand the difference first. So, what is over-capitalization? It is a structural issue where a company has raised more capital through debt or equity than it can profitably employ over the long term. So, it is a structural issue, it is a long term issue where a company has raised more capital either through issuing equity shares or issuing debentures. The overall capital structure is too large for the business capacity to generate returns, right. What is the focus of this? It emphasizes on the relationship between total capital raised and the company's long term earning capacity. The two variables that is taking into consideration is the total capital raised and the long term earning capacity of a business. What is the time frame here? Long term problem that affects company's financial health and profitability over time. So, it is a long term problem for a company and it needs to take certain steps if you want to correct that problem. Now, what is excess capital? It is a temporary situation where a company has more cash or liquid assets than its currently needs for its immediate operational needs of in a short term surplus. So, it is a short term approach, it is not a long term problem, it is a temporary situation where a company has excess liquid cash which it requires to manage its business. Now, focus is emphasizes on the amount of liquid assets available and whether it is being put to productive use. So, the two variables here are the liquid assets that is available with the company and whether it is being put to some productive use or they are lying idle, right. Time frame is, it is a short term situation and the company may have plans for the excess cash in the near future. So, let us say because of the some seasonal variations, let us say there is a holiday season and company has a lot of sales and they have got a lot of cash. Now, they can use this cash to purchase the raw materials for the next season or they can pay dividends. So, this can be used, right, this can be deployed. On the other hand, when we talk about over capitalization, let us say a company overestimated the demand for the products and raised 50 lakhs and all of a sudden the demand for the product goes down. Now, based on the demand they have raised 50 lakhs through debt, but now company finds it harder to use that and it is a case of over-capitalization. Causes of over-capitalization. First one is over-issue of capital. When you overestimate your financial requirements, right. When you overestimate the financial requirements on the basis of the highly optimistic sales or all these things, you try to raise more, but then you realize that you do not have the enough investment avenues to put them effectively into use. That situation leads to the condition of over-capitalization because you cannot generate decent returns on the investments that you are making. Inadequate demand for products, that is return on capital employed goes down. The company projected a good return or a good demand for the product, but all of a sudden the demand goes down. So, obviously the return on the capital will also go down. Payment of high rate of interest. Company has issued a lot of debentures and is paying a very high rate of interest. Irrespective of the fact whether they are able to put it somewhere, they need to pay a high rate of interest. So, that is also one of the causes of over-capitalization. Underestimation of the capitalization rate. This we have seen in the previous slides because when we try to calculate capitalization, we divide the expected earnings divided by the capitalization rate. So, in case the capitalization rate is underestimated, we are using a lower capitalization rate, obviously the capitalization will go higher. So, company needs to determine the capitalization rate in a very fair way. Acquiring unnecessary assets. So, let us say the company is overspending on what? Some luxury items, some office expenditures, lavish travels, providing multiple cars to employees or something like that which are not into productive use. So, in that case the over-capitalization of the company might come into play. Then unnecessary expansion, without planning you have expanded unnecessarily. So, that requires a lot of money. So, in that case also you will be raising a lot of money and you are not getting return on that, right. Let us say you entered into a market and you found that the demand for the product is not there. So, in that case over-capitalization might be there. High initial cost, there is a high startup cost. You have invested a lot in R&D, but that does not give you a profitable product, so that goes in vain. Marketing campaigns, you invested on a very large scale in a marketing campaign, but it could not get the attention of the consumers and you could not increase the sales, that could again lead to overcapitalization. Mergers and acquisitions, you are paying a lot for acquiring a company, but that doesn't turns out to be a good deal. Why it doesn't turns out to be a good deal? Because there is a lack of due diligence. You didn't spend enough time to make investigations about the profitable synergies that will be there after the acquisition, that is the synergy failures. Now, what are the effects of overcapitalization? So, the first one is loss of goodwill. So, if a company is not able to generate decent returns on its investments, the share prices will go down, and because of that the interest of customers or the trust of customers will also go down. So, there is a loss of goodwill for the company. Poor credit worthiness, there are delayed payments because company is not able to generate good returns. So, creditors might be paid a bit late, the loans and all things will be creating a problem for the company. So, the credit worthiness of the company would be going down. Difficulty in obtaining capital, investors lose confidence. As we have already discussed, when there is a case of overcapitalization, the market price of the shares go down, the earnings decrease. So, investors lose confidence in a company and it becomes more difficult for a company to raise further capital. Liquidation of the company, if the overcapitalization issue is not resolved, the end result might be liquidation, right? The company will find it harder to make payments to the debenture holders, creditors, and inability to do so, it will lead to the liquidation. Reduced dividends, that is low rate of return earnings on its capital. So, obviously, when the earnings decline, dividends are bound to decline because company is not earning enough so that it can pay dividends to the shareholders, and because dividends are paid out of profits. Profits go down, obviously dividends will also go down. Loss to consumers, because the company is not making sufficient profits. So, in that case what it will do, it will try to increase the prices to compensate for that, or it will try to reduce cost by using a poor quality product. So, in both the events the consumers at loss because they are purchasing a poor quality product at a higher price. Loss to workers, because the company is not able to generate decent returns. So, in that case they might not be ready to increase the wages of workers. In some cases they might be closing down some units. So, in both the scenarios the workers are at loss, they may lose their jobs also. Inefficient use of capital, because company has excess of funds, it is not having profitable ventures where it can put that money. So, they are putting that money in certain ventures where they are not generating decent returns. So, they are putting that into low return unproductive assets. It sends a negative signal. How? Inefficient resource management and lower potential returns. So, company is not able to utilize its resources, the capital in an efficient manner, and the returns are also going down. So, it sends a negative signal to the investors. Now, what are the remedies for overcapitalization? Now, overcapitalization, you can consider this situation as a very fat person who can suffer a lot of other diseases if it doesn't cuts down or reduces his weight. Similarly, overcapitalization is a situation where a company should cut its dead weight because the repercussions will be much more difficult to handle if it keeps on continuing like that. So, the first remedy for getting rid of this issue is efficient management or curb excess expenditure. The company should try to reduce its expenditure as quickly as possible, curb the excess expenditure, and this can be done only with the help of efficient management. Redemption of preference shares, redeem preference shares using retained earnings to raise the earning capacity of the equity shareholders. So, company has to pay dividends on the preference shareholders, and because of that the share of dividends of the equity shareholders is also less. So, the first thing the company should do is redeem the preference shares using the retained earnings that the company is having. So, that will raise the earnings available for the equity shareholders, and the company will not have to pay dividends to the preference shareholders also. Reduction of debt, loans and debentures having high interest rates should be prepaid using retained earnings. If the company is having sufficient retained earnings, the company should get rid of the debts that they have taken at a very high rate of interest. It will help company to have some stability because it will get rid of the burdens of paying fixed interest charges every time. Buyback of shares, reduce equity and improve EPS. If a company has issued too much of equity shares, so in that case the company can buy back few of the equity shares. It will also improve the earnings per share of the company because limited number of shares will be there. So it will again sort out this issue to an extent. Invest in profitable projects. Use excess capital to invest in profitable ventures, because company has a lot of fund, lot of excess funds. So company should be keeping all its eyes open, looking for all the potential good opportunities to make investments. If it finds any good opportunity, it should use that excess capital there. Improve operational efficiency. Company should try to reduce its cost, streamline the processes, reduce waste and improve productivity. Doing all these things, the company can to an extent sort out the issue of overcapitalization. And finally, consider mergers and acquisitions, because company has excess capital. So it has the capability of going or purchasing some company where it can find synergy, but obviously proper due diligence should be done before pursuing with an acquisition. So these are the references which you can go through. These are the books which you can read to have a better understanding of the topics that we have discussed. Thank you so much.